Good morning. Well, that's what it is when I'm doing the video. It's morning. And hope you had a chance to look at the other videos and get your Chapter 9 work done on time. This is going to be Chapter 10. In Chapter 10, there's a lot of little topics that kind of run into each other. So I'm going to try to break this down into 2 videos, I think, because I don't want them to run too long. But Chapter 10 is stockholders' equity. Now, this is this comes from page 135 in the book. I think it's Chapter 3. And the reason I'm showing you this is because this is what we're talking about, stockholders' equity. Now, in Accounting 101, it really didn't get any more complicated than this. All you had was common stock and retained earnings. We're going to see now that that gets a lot more complicated. There's more to stockholders' equity than just common stock and retained earnings. So in Accounting 101, if you had a common stock transaction, it was typically the first transaction in the problem. The owner started the business. The owner started the business by contributed $25,000, say, in exchange for common stock. And what journal entry did we make for that? Debit cash, credit common stock. That's an example of what's called no par common stock. In other words, we didn't attach any value to the common stock other than that $25,000. Debit cash, credit common stock. We're going to learn something in Chapter 10 about par value, that we can assign some kind of a minimum amount to common stock, and then there could be amounts that are in excess of that. Retained earnings is an account that we hardly ever use, right? What does retained earnings represent? Well, the word retained means keep, and earnings means net income. So how much net income does the company keep or retain? Now, we saw in Accounting 101 that the only way numbers got into the retained earnings account was through closing. And that's pretty much going to be the same way it's handled here. Retained earnings is increased by net income, and it's decreased by dividends, right? So that's pretty much the same. Think of common stock. We're going to see that there's more to this than common stock. Think of this as being 2 separate sections within stockholders' equity: invested capital and retained capital, right? That's the way your book presents it. So let's go back to your book, right? And that was in Chapter 3. So you can go back and look. And now we're going to go to Chapter 10. Now, they start out with a whole discussion of the corporate form of ownership, right? And that's something that you can just read. You may have even come across this in another course, like an intro to business or a business management course, or even a basic business law course. You may have come across this before, but very briefly, the stockholders elect who's on the board of directors, and the board of directors in turn hires the chief executive officer, who is very often the president of the company, and then the president of the company hires a management team, right? The various vice presidents. So I'm not too, okay, let's talk about this for a second. Public or private. Now, who owns the stock in the corporation? If it's a private corporation, that's, just ordinary people for the most part. corporations can be very large and they can also be very small. The smaller ones tend to be privately held. The bigger ones are publicly held. In other words, a public corporation has their stock trade on one of the exchanges. So they give you some examples of publicly traded companies like Walmart, Exxon, General Electric, Apple, Intel, etc. Privately held companies can still be pretty big, right? But they just choose not to trade their stock on the stock exchanges. So they give you some examples of their company called Cargill, Koch Industries, Mars. These are examples of privately held companies. Now, you could have also, as you're driving up and down Hempstead Turnpike or Old Country Road, you see a lot of little shops and restaurants and stores. A lot of those are corporations too, and they're typically owned by a family of, could be one or two or three, 10 different people, right? So that's this public versus private. So we're going to be talking mostly about publicly held companies, right? Because chances are when you get out of school and go to work, you're going to be working for a publicly held company, but a lot of the same rules apply to privately held companies as well. Stockholders have rights. So if you own shares of stock, you own rights. The most important one is the right to vote. You typically vote for who's on the board of directors, and sometimes you get to vote on some policy matters. You have a right to receive dividends if the company declares dividends. If a company does not declare dividends, you don't have a right to receive anything, right? But if the company does declare a dividend, you have a right to receive that dividend. You have a right to share in the distribution of assets if the company is dissolved. So if a company goes out of business, typically a company will go out of business, it'll sell all the assets, it'll pay off all the liabilities, and if there's anything left, any cash left, they will distribute it to the stockholders. But chances are, most of the time when companies go out of business, there is no cash left. So main advantage of a corporation is this thing called limited liability. Limited liability is the definition. Stockholders can lose no more than they have invested in the company. Corporations also have the ability to raise capital by selling shares of stock. And it's easy to transfer ownership. If you don't want to own your stock anymore, you just sell it, call up your stockbroker and sell it, or go online in your online account and sell it, and you get your money in a matter of days. Disadvantages, you wind up paying additional taxes as a corporation. The corporation pays a tax on any profits that it has. And then if those profits are distributed to stockholders, the stockholders have to also pay personal income tax. So that's known as double taxation, right? So here they give you a definition of that. Paperwork. Corporations require lots of paperwork. All businesses require lots of paperwork, but the corporations require more than most. That liability issue is the main reason why companies incorporate, even small ones, even a one-person business. You decide when you graduate from college you want to start your own little business. You probably at some point will decide to incorporate because you don't want to lose your house, your car, your life savings if something goes wrong. Okay. Let's talk about this. This is very important. Authorized, issued, outstanding, and treasury stock. So when you decide to start a corporation, you have to apply. You just can't start a corporation. You have to apply for permission to do business as a corporation in the state where you intend to do business. So for us, it would be New York. And the government agency is called the Department of State. So you would contact them and tell them that you want to incorporate. This could all be done online, by the way. Most people use a lawyer to do this, and I'm not suggesting that you shouldn't do that, but it's not as complicated as it used to be. It can be done online. The lawyer is also going to give you other types of advice, so it's not It's not a smart thing to do it by yourself. You probably should use a lawyer, but it's not a difficult thing to do. So when you form this corporation, when you ask for permission, you're going to fill out a form called the Articles of Incorporation, and sometimes it's called a charter. You are going to ask for permission to do business in the state, and you are going to ask for permission to sell stock in the state. The number of shares that you ask for in the charter are called the authorized shares, authorized stock. Total number of shares available to sell. The issued stock is the number of shares that have actually been sold. Now, I like to use the word issued because sometimes we're going to see that sometimes stock doesn't have to be sold to be given to investors. A company usually does not issue all its authorized stock, right? They always like to leave some in reserve for certain reasons. So authorized is the total amount that you're allowed to have, and issued is the actual amount that you have distributed or issued to stockholders. Now, outstanding stock. What's outstanding? It's the number of shares held by investors. Well, isn't that what issued stock is? Not really, because sometimes companies will buy back shares of stock, and that's stock that is not being held by investors. And then they mention here only outstanding shares receive dividends. So that's an important thing to remember. When we do the problems, you'll see. Treasury stock are the number of shares that were repurchased by the company. So issued shares minus treasury stock equals outstanding shares. Right? And here they show you authorized stock is the whole circle. Outstanding stock is what's in the hands of the stockholders. Treasury stock is stock that was bought back. But if you add the treasury stock and the outstanding stock together, that gives you the issued stock. So I hope that explains it. We're going to do a problem. I don't know if we'll get to it in this video, but we're going to do a problem where we're going to analyze that. Okay. Now, in Accounting 101, this is how we learn to record the sale of common stock, right? We debit cash, credit common stock. That's what's called as no par common stock. But sometimes we'll see that stock has what's called a par value. A par value is a legal concept. It has nothing to do with market value. See here, this was market value, right? Debit cash, you sold 1,000 shares, the market price of the stock was 30, debit cash, credit common stock. The reason for par value is a legal reason, not an accounting reason per se. But as accountants, it helps us keep track of the number of shares. And knowing how many shares are floating around is a very important thing, because if we ever have to pay a dividend, we need to know how many shares of stock are going to get the dividend. That's a very important thing to know. So if we have no par stock, we have debit cash, credit common stock. But if we have stock with a par value, we're still going to have the debit to cash for the same amount, but we're going to have a credit to two accounts. We're going to have a credit to common stock for the par value, right? And let's say, for example, the par value is $1,000. So debit cash 30, credit common stock 1. You need to credit something for $29,000. What would you credit? You have an account called, sometimes it's called additional paid-in capital. Other times it's called paid-in capital in excess of par. All right, and here is what they did, right? So here, they're telling you that the common stock has a par value of 1 cent per share, 1 penny a share. So if I multiply 1,000 shares times 1 cent, that comes out to $10. Well, I got a debit of 30,000 and a credit for only 10. That means I need an additional credit of 29,990. That's what we call additional paid in capital. So that's something new, right? That's something new. Okay. Let's look at a homework problem. All right, let's look at this one, number 4. Brief exercise 10-4. This is on page 523. Gothic Architecture is a new chain of clothing stores specializing in the color black. Okay. Gothic issues 1,000 shares of its $1 par value common stock at $30 a share. Record the issuance of the stock. How would the entry differ if Gothic issued no par value stock? Right, so let's see if we can do that. This is BE brief exercise 10-4. And this was on page 523. Right, and we're going to do journal. Most of what we're going to do in these next few problems are journal entries. So let's make this out to be journal entries. Okay. So, is there a date? They didn't give us a date, right? You want to use today's date? Today is what? May 26th. Right? Now, we're going to debit cash. And we're selling 1,000 shares, and the market price is $30 a share. That's a debit to cash of $30,000. Credit common stock. 1,000 shares times, they said the par value was $1 per share. Credit additional paid in capital. Now, in the book, they said, well, okay, I got a debit of 30, I got a credit of 1. That means I need a credit of 29. Yeah, I mean, that's fine. You can do that. But you can actually calculate that number, can't you? In other words, it's 1,000 shares times what? 29, isn't it? All right, let's take a look. I got a debit to cash for $30 a share. I got a credit to common stock for $1 a share. And I got a credit to this additional paid in capital for $29 a share. Right? So that's another way of looking at it. It's a little more analytical, but it's just another way of looking at it. Now, that's if the stock is par value, right? Par value stock. What if we had no par stock? That's the accounting 1 stock. right? So May 26, you would do what? You would debit common stock. Oops, no. Ooh, I should say something about that. We debit cash, 30,000, same as before. And credit common stock, 30. Get rid of that. Okay. And that's an example of no par, right? So this is, I'll put here, this is the ACC 101 method, right? And this is the ACC 102 method. So that's all there is to that, right? All you're doing is you're taking the $30 and you're splitting it into two parts. You're splitting it into a $1 part and a $29 part, right? That's all of it. That's all this means. Okay, now let's go back. Some companies, not many, some companies can have more than one type of stock. Every corporation has to have common stock, right? Every corporation has to have common stock, but sometimes companies have additional stock. It's called preferred. Now, when you hear the word preferred, you think what? You think it's better. It's not better. So why is it called preferred? It's called preferred because they receive their dividend before common. So if there is a dividend, and there doesn't have to be a dividend, by the way, but if there is a dividend, they would receive their dividend before the common stockholders do. They also have a preference when it comes to distributing assets if the company is dissolved or liquidated. Right? So remember, we talked about that before, that if a company decides to go out of business, they will sell all their assets, right? Turn it into cash, take the cash, pay off the liabilities, and if there's anything left, distribute it to the stockholders. If a company has preferred stock, they get paid first. And then if there's anything left over, it goes to the common. Now, when it comes to preferred stock, right, they have various features. Not all. Not all preferred stock has these features. But if you, before you invest in preferred stock, if you were tempted to invest in preferred stock, you should know, right? You should know what you're getting. So convertible preferred stock, that can be converted into shares of common stock. And sometimes that's a nice thing to have. Sometimes preferred stock can be redeemable. In other words, the stockholder can give it back to the company to get their money back. Now, what's the difference between redeemable and callable? See, in the chapter with bonds, we had that call feature in a bond, that the company has the right to buy the bond back from you before maturity, right? And we even looked at the journal entry that gets made in that case. Well, sometimes the difference between redeemable and callable is who has the option to get paid, right? So callable, the company has the right to buy the stock back from you. Redeemable, the stockholder has the right to get their money back. Cumulative. Cumulative means that if the company ever misses a dividend payment, before anybody can ever get a dividend in the future, that dividend that was missed must be paid first. right? So cumulative is a good thing to have because if a company misses a payment, right? Let's say company's going through a rough time and they have to miss dividend payment 1 year. The next year, before they can pay anybody, they have to pay you the dividend that was missed. When they miss a dividend, that's called dividend in arrears. See the term here? Dividend in arrears. Right? And then here they summarize something, the differences between common and preferred. Right? Look at the first one. First one is a big one. The right to vote. Common stock, yes. Preferred stock, no. Preferred stock does not. They say usually no. I've never seen a case where preferred stock can vote. So that's a main difference. Preference for dividends, right? And interest. Well, bondholders get paid first, and then that's interest, isn't it? Remember, what's the difference between stocks and bonds? Bonds is a contractual arrangement between a lender and a borrower. So if the borrower is unable to pay interest, they're in breach. That's a terrible legal thing. But when it comes to dividends, it's not as serious from a legal standpoint because you don't have to pay a dividend. Right? So here it kind of gives you the difference between the two. Right? That's a nice thing to read. Again, I don't think it's going to come up in the kind of things we're doing. Right? Now, I wanted to do with you another one of these brief exercises. Let's see, which one was it? Number 7, brief exercise 7. Rachel's Designs has 2,000 shares of 7%, excuse me, par value, cumulative preferred stock issued at the beginning of 2019. All remaining shares are common stock. Due to cash flow difficulties, the company was not able to pay dividends in 2019 or 2020. The company plans to pay dividends of $23,000 in 2021. How much gets paid to the preferred and how much gets paid to the common? Right? So let's see if we can handle that. So this is brief exercise 10-7, right? And I believe this is on the same page, page 523. Okay. Let's figure out what would the preferred stockholders get in a normal year, right? So let me call this normal dividend that preferred stock would get. Okay, so how do we figure that out? They have 2,000 shares of stock, and it has a par value of $50 per share. So 2,000 times 50 is $100,000. The dividend is 7%. Right, isn't it? So 100,000 times 7 is $7,000, right? So the normal dividend that the preferred stock would expect to get, assuming everything was okay, would be $7,000 in a year. Okay. So let's make 2 columns. One for the preferred and one for the common. Right, and remember that this is cumulative preferred stock. I'm going to put that over here. Cumulative preferred stock. So the problem says they didn't get anything in 2019, but if 2019 was normal, they would have got $7,000. They didn't get anything in 2020 either, but in a normal year, they get $20,000. Now, 2021 is the year that they're going to pay. So in 2021, they would expect to get $7,000, right? I'm going to say one more thing here. 2019 was in arrears, wasn't it? 2020 was in arrears. That strange word, arrears, meaning behind. Okay, so 777 is 21. How much is left? The total dividend was 23. So if the total dividend is 23 and 21 goes to the preferred, how much will go to the common? 2, right? 2. Now, if it wasn't cumulative, right? If it wasn't cumulative, what if it was non-cumulative? Right? What if it was non-cumulative? Well, we wouldn't worry about the things that happened in the past. They would have gotten 7. Right? So how much is left over? 16 to the common. So you see how nice it is to have that cumulative feature if you're an investor? Right? If you didn't have it, you only would receive 7,000. You would have gotten nothing for 2019 and 2020. And the bulk of it would have gone to the common. The fact that it's cumulative makes it just the opposite, doesn't it? Okay. So I'm going to stop the video here, and there'll be another one, part 2, with the remaining topics that are in the chapter.